the huge role of the US dollar on world markets, any shift in policy at America's central bank, the Federal Reserve, creates ripples that are felt right across the globe. The World Bank is warning that those ripples may turn into a perfect storm for some developing countries. Those reliant on commodity exports and with high levels of debt appear to be most vulnerable.
Now, commodity prices have halved from the 2011 peaks. And for oil, they've halved not from 2011, but from last year. So it's been a precipitous decline. That has reduced government revenues and forced governments to cut spending at the same time that growth is anyway slowing. It has also reduced investor confidence in the growth prospects of these countries.
When Fed rates are hiked, the dollar tends to strengthen against other currencies and magnifies the costs of servicing debts locally, according to development economist Ben Leo.
If the country's currencies depreciate, that debt becomes a whole lot more expensive. So that's something to really watch in terms of being able to pay the loans, as well as the overall size of the loans in a more general sense.
During times when markets are volatile, investors often choose to withdraw from nations perceived to be more risky, causing lenders to demand higher interest rates known as a risk premium.
And if there's significant capital outflow, then that's going to mean a very significant disturbance to that particular economy, and that's going to have an impact on everyone.
The Federal Reserve has long signaled that it anticipates a gradual increase in the path of rising interest rates, raising further risks of volatile market reactions. So the World Bank is advising these most vulnerable countries to improve their overall investment climate now in order to persuade those foreign investors to stay the course. Daniel Ryntjes, CCTV, Washington.
And Ryntjes now joins us live from Washington, D.C. with a lot more data from the FOMC meeting. Daniel, it seems the committee decided to err on the side of caution here. Why exactly has Madam Yellen and company decided to hold off on raising the Fed funds rate?
Yes, the statement suggests that they still see in the near term inflation remaining low, but in the medium term to long term, they expect inflation to start pumping up. There are also concerns about whether the good job numbers really reflect a sound jobs market underlying, that these are good jobs, long-term jobs, well-paying jobs. So that's part of their mandate. And the other thing is that they say they are monitoring global developments. So it suggests that they are adopting a wait-and-see approach, although they don't use that particular terminology, before deciding whether global turbulence is going to impact their projections moving forward.
Indeed. Now that normalization has been pushed further out, when exactly will it begin? Has the committee given any indication whatsoever?
Well, they have not given any more indication as to the exact timing. And so we're left wondering again, there's a certain degree of uncertainty about when that might be. But I can tell you that most economists who look at this stuff suggest that there's a reasonable possibility that they will still stick to their original plan, which was to do so sometime this year. The betting at the moment is on a December rate hike of between 0.25 and 0.5% on the federal funds rate. But again, there is still in this statement a great deal of uncertainty, and they say they will continue to monitor the data before making any further decisions.
Right, then we'll leave it there for the time being. Thank you for the update. That's Daniel Ryntjes live in Washington. Of course, the press conference by Janet Yellen is right at the bottom of the hour, just about the time that we'll switch over to dialogue around 09:30 or so, 2:30 p.m. Eastern Time on their end of the world.